Hey everyone, welcome back to Corporate Decoder. Today, Customers Bancorp CUBB just filed their second quarter 2026 report, and I'm seeing one massive change in their loan book that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing some seriously impressive profit growth, but a closer look reveals a big shift in how they are managing their money, especially in their loans. Let us dive straight into the financials. Customers Bancorp is reporting some really strong numbers for the second quarter of 2026. They saw net income jump to over $141 million for the first 6 months of the year, a huge leap from about $73 million in the same period last year. That is almost double the profit. Looking at the balance sheet, total assets grew to about $26.5 billion by the end of June 2026. That is a solid increase from $24.9 billion at the end of 2025. What is driving this growth? Well, loans and leases receivable shot up by over $1 billion, hitting $16.2 billion. On the other side of the ledger, deposits also grew, reaching nearly $21.7 billion, an increase of almost $1 billion. This means more people and businesses are trusting them with their money. Now, let's break down that profit growth. Net interest income, which is the difference between what they earn on loans and what they pay on deposits, saw a good bump for the first 6 months of 2026. It was around $384 million, up from about $344 million in the same period last year. This is largely thanks to that big increase in their loan portfolio. They are making more money on the loans they are issuing. Interestingly, while their loan book grew, their provision for credit losses actually decreased slightly for the first 6 months of the year, down to about $46 million from $49 million last year. This suggests they believe their loans are getting safer, or at least their estimate of future losses is going down. However, they did have a significant chunk of impairment loss on debt securities in 2025 that is not there in 2026, which boosted the 2026 numbers by comparison. Non-interest income also saw a huge jump, mainly because of a large impairment loss on debt securities in 2025 that didn't happen this year. Without that, other areas like commercial lease income and loan fees are growing nicely. Commercial lease income alone jumped by almost $9 million in the first half of 2026. On the expense side, salaries and employee benefits went up significantly, by over $18 million in the first 6 months of 2026. This is likely due to hiring more people to handle the growth, especially in their lending operations. Commercial lease depreciation also jumped, which makes sense if they are expanding their leasing business. Let's talk about the loan portfolio itself. Commercial and industrial loans, especially that specialized lending category, saw a massive increase. This segment grew by over $1.1 billion in the first 6 months of 2026, accounting for a huge part of their overall loan growth. This indicates a strong focus on commercial clients. However, notice the loans receivable installment at fair value line. This actually decreased by about $17 million. This is interesting because it points to a potential shift in their consumer lending strategy, moving away from these specific types of installment loans. The allowance for credit losses, which is essentially their safety net for potential loan defaults, increased to about $164 million. While their loan book grew, this increase in reserves is a sign they are being cautious, especially with the economic uncertainties we are seeing. Now, for a really significant detail, look at how they value their loans. A huge chunk of their loans, over $16 billion, are categorized under level 3 inputs. That means they are valued using unobservable inputs, which often involve more estimation and are less certain than values based on readily available market prices. This is especially true for their commercial and industrial, including specialized lending loans. When a company relies heavily on these level 3 valuations, it means their reported asset values are more sensitive to management's assumptions. For their asset-backed securities, also in level 3, they are using discount rates and annualized loss rates as key unobservable inputs. For example, their discount rate for these securities ranges from 7 to 9% with a weighted average of 7%. The annualized loss rate is between 5 and 7%. These numbers are crucial because even small changes here can significantly impact the reported value of these assets. Let's check their asset quality. Non-accrual loans, which are loans where borrowers are having trouble paying, are sitting at about $56 million. While this is not alarmingly high compared to their total loan book, it did increase from the end of 2025. The bank does have a significant allowance for these loans with reserves for none. Accrual loans covering them over 290%. On the funding side, deposits grew nicely, which is a positive sign. they saw a nearly $1 billion increase in total deposits, reaching $21.7 billion. A big driver here was non-interest bearing demand deposits, which went up by over $600 million. This is great because the bank doesn't pay interest on these funds, helping their profitability. However, they also significantly increased their FHLB advances, which are basically borrowings from the Federal Home Loan Bank. These jumped by over $730 million to reach $2.1 billion. This suggests they are not solely relying on deposit growth for their funding needs and are leveraging other sources, perhaps to fuel that aggressive loan growth. Now, a word on their stock and insider activity. The company's chair sold a pretty significant chunk of shares recently, around 68,000 shares. Also, a director proposed to sell nearly 8 million shares. This kind of selling by insiders can sometimes signal a lack of confidence, or it could just be for personal financial planning. Looking at the bottom line, net income available to common shareholders showed a strong increase of over 28% for the quarter, and a massive 116% increase year over year for the first 6 months. This is impressive, driven by that net interest income growth and the absence of that large debt security impairment charge from 2025. So what is the story here? Customers Bancorp is definitely growing its loan book, especially in specialized commercial lending, and their profits are looking good. They also managed to attract more low-cost deposits, which is a big win. However, the reliance on level 3 valuations for a significant portion of their loans means their reported asset values have a degree of estimation involved. The increase in FHLB advances also indicates they are actively managing their funding mix. The insider selling, while not always a direct negative, is a notable data point given the growth. My biggest concern is how they manage the risk associated with that rapid growth in specialized commercial lending, especially since a large portion is valued using less observable inputs. What I am actually looking for is how these level 3 assets perform in different economic scenarios. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.